Am I buying Tesla stock? Tesla stock is down more than 50% since its all-time high. This is the biggest drop for the company since its meteoric rise starting in late 2019. But is this drop enough for it to make it a good investment, or am I going to wait out a bit longer? Stay tuned to find out this and many other important topics and valuable information. As always set with educational purposes, and it is not meant to be taken as financial advice. During Q3, Tesla reported they have grown their top-line revenue with 56%. At the same time, its bottom-line net income growth was 75%. These growth rates are not only industry-leading, but the company is a top grower for any industry at all, especially taking into consideration their size. Total revenues for the quarter amounted to 21.45 billion, of which about 87% came from automobile sales, and the rest 13% came from the solar segment of Tesla, their insurance arm, their store services, and superchargers. The company reiterated again their beliefs that over the course of the foreseeable future, its number of vehicles sold will grow by 50% on an annual basis, which is quite extraordinary. On the chart, we can see how the market share of Tesla's vehicles is on a continued rise in all major markets. About 3.5% of the market in North America and a little less than 2% of the market share held in China and Europe belongs to Tesla. Some experts believe that in the future, an even more important segment for Tesla will be its energy storage battery business. This is also according to Elon Musk. The energy deployment of Tesla grew by 62% year on year. It reached an all-time high of 2.1 gigawatts per hour. Moreover, its solar business grew by 13% year over year. The physical store services and other parts of Tesla's business, as they put it, also grew quite a lot, and it had an increase of 3x from the prior year's quarter. Tesla's cash and cash equivalents are sitting in at 21.1 billion, which, as they stated, gives them sufficient liquidity to expand all of their future plans and business ambitions. This is terrific as the business has finally managed to reach a turning point, in which most likely no more shares will be issued. Share issuance is a silent killer for all investors. To give an example, if a company today has 10 shares and you own one of these 10 shares, you are entitled to 10% of the profits. If a company then issues 2 more shares and makes the total share amount 12, you will now own only 8.33% of the company, and you just got diluted and your future returns will be lower. The best thing is for a company to implement share repurchases, but only if the stock price is lower than its fair value, which increases the shareholders' returns. If share repurchases are made when the stock price is overvalued, this destroys shareholders' capital. On the following chart, you can see by how much Tesla is outperforming in terms of business growth. As the auto industry is having a close to zero or a negative revenue growth, Tesla is having close to a 60% consistent revenue growth, which is also about 4 times the average growth of the S&P 500. Also, from a business efficiency standpoint, Tesla is crushing its competitors from the auto sector, as their operating margins are more than twice those of their competitors. Standing at 17%, the operating margins of the S&P 500 on average are about 15%, while the auto sector has margins of about 8%. Also, finally, we can see that Tesla has a proven business. A business is proven only when it has consistent free cash flow and net income profits. Otherwise, it is funded with debts or share dilution. The following chart is on a trailing 12-month basis. So basically, the free cash flows over the last 12 months amounted to $9 billion, while the net income is around $11 billion. But is Tesla undervalued or overvalued on its growth and current earnings? Let's find out. The current PE ratio, which is used to see what is the multiple on the company's earnings, is sitting at 59. This is quite a high level on its own, but considering the growth rate of the company, it is not that high. In order to understand how to value a proper price-to-earnings level, we must know the Peter Lynch rule. He says that the PE should be lower than the company's future or trailing growth rate. It is always better to look at the future as we invest for future growth. Past growth is already in the past. So if Tesla currently has a PE of 59, it must grow in the future with at least 60% per year. While this is possible, I cannot say it is probable, nor can I say it is certain. In order to never lose money in the realm of investing, we must always be conservative. I would assume that a more realistic future growth for the company would be around 30% per year. This means that the current PE is too high for me, which means the market is still having quite a positive look on Tesla, and we want to buy when the market is fearful. As Warren Buffett says, be fearful when others are greedy, and be greedy when others are fearful. But let's assume the following. If Tesla grows its net income from about 11 billion to 16 billion next year, then that gives us a forward PE of the company of about 37.5. This is actually what most analysts expect as well. But again, in order for me to feel more secure about an investment in Tesla, I need today's price to fall by another 30%. The current market cap of Tesla is 600 billion. A 30% drop would mean the company needs to go to 420 billion. Whether an investment is good or bad is all dependent on the price, and for me, Tesla currently is a unique company with a bit overvalued price. Subscribe to the channel for more insights into the world of stocks, and if you want to learn more about economics, comment down below which other topics you want me to cover next here. And I'll see you in the next video.